The currency space, the dollar appears to be succumbing to downward pressure from lower U.S. debt yields as investors now remain jittery after last week's surprisingly dovish FOMC policy statement. Dominic Bunning, the Associate Director of Forex Strategy at HSBC, now joins in from Hong Kong. Hi Dominic, thanks much for speaking with us. Dollar is already at that 97 odd levels now. How big a correction could we be looking at?
I think, in terms of setting specific levels on it, we've seen a pretty big move already from the low in euro-dollar, for example, coming up to near the 110 level. We don't think there's necessarily an aggressive fall in the dollar to come now, but what we are saying is that we think that the dollar rally in the longer term is starting to come to an end. We're going to see a period now of a more sideways move in many respects versus a number of currencies for the US dollar, because the strength of the dollar is starting to have a more negative impact on the US economy. That could feed into maybe slightly softer US rate expectations. And also, we're quite heavily positioned long dollars. We've seen a big move. We just think there's a little bit more room for this stabilization in the near term to continue.
Okay. So, Dominic, on an average, perhaps, what could be the dollar index or even the euro-dollar in the coming 3 months or 6 months, or perhaps even by the end of, this calendar year?
Yeah, well, as I say, we're not looking, as I say, for euro-dollar to really move aggressively high this year. We've still got euro-dollar at 105 by the end of 2015, but I think it could be quite a choppy, volatile range in getting there. A number of other houses, for example, have started to chase spot lower and are looking for euro-dollar to break parity. We don't believe in that story in our base case. Obviously, there are some downside risks politically in Europe, for example, or if the dollar rally starts to gain a lot more traction in other places, such as versus the yen or versus emerging markets. But we actually only think that we're going to see some slight strength in those different areas, and actually in terms of the euro-dollar rate, we'll be in a largely sideways pattern, although there will be some volatility around that.
Also, Dominic, in your latest report, you say that the danger of a destructive USD rally still remains. What is it that could trigger something like this?
I think one of the biggest factors to think about is in terms of emerging markets and what the stronger dollar can mean for some of those markets where there are high levels of external debt, for example, and where a stronger dollar makes it more difficult for local companies to pay down that debt which is denominated in dollars. So I think what we've seen at the moment in EM in particular is a lot of domestic stories which are causing local currencies to weaken. So Brazil, for example, Russia, Indonesia and Malaysia in this part of the world have all seen coming under pressure. But I think that's more been due to domestic dynamics. If we start to see the dollar trend really kick higher again, then that could actually become a lot more dangerous for emerging markets, currencies and emerging market economies as well.
All right, Dominic, we'll leave it at that. Thanks so much for joining in.